All right, happy February 1st, everyone. Let me make sure that my mic is. Happy February 1st, everyone. Let me make sure that my mic is. Happy February 1st, everyone. Let me make sure that my mic is. Happy February 1st, everyone. Let me make sure that my mic is. Happy February 1st, everyone. Guys. Let me make sure that my mic is. Happy February 1st, everyone. Guys. Let me make sure that my mic is. Happy February 1st, everyone. Have the Twitch stream in the background. All right. Happy February 1st. Should be good to go here. And I am back from my vacation hiatus, and there are a lot of great things happening in the land of BA Pig, and yeah, Kobe kind of shouting us out, and yeah, just the markets are really showing some volatility here, and I kind of want to show anybody that may be new coming into the BA Pig universe kind of how to set some things up and use these great indicators, these mathematically based indicators, mathematically coded indicators to your advantage that BA Pig so graciously lets us use for free. And then there are some premium indicators over here. These are all premium indicators. Yeah, so thanks for bearing with me through some technical difficulties, and we'll be getting going here in a minute. Just gonna check up on some things and make sure that we're all good to go. Okay, yeah, so just checking some things out on Discord. So we're going in here. It's been a hell of a rally coming off of the lows here in some of the major indices. So let's kind of go in and just from a perspective of somebody new coming into the BA Pig kind of methodology of trading and viewing markets and being able to set some things up. Okay, so there are a couple areas of quantitative finance that are kind of integral to be able to view things unbiasedly and just checking for market extremes and statistical outliers, things along that nature. So volatility would definitely be a centerpiece, a spoke, or a pillar on the foundation of being able to realize where markets have a propensity to move and things along those lines. So volatility is definitely one that you want to have up on your trading view chart. And BA Pig has graciously given us the historical volatility estimator, so you can go over to the indicators tab and you can pop this up right here or you can just put it in. So once you get to the indicators kind of tab here, then you can go over and you can so you can pull this indicator up, historical volatility estimator, and that's right there. Let me just grab this for 1 minute here so I can keep tabs on the chat going on here. Make sure that we have the chat going as well. All right, everything looks good as far as that goes. All right, and our so bad. So I also need to update our title as well. Put that in there. I switched over software, so I'm a little bit new to this. Thanks, Mints. Yeah. So let me just try to change this real quick. Oh, word, Weebos, my man. Hope everything's going well. And besides the fact that I'm using an old. Okay, now I can edit this. Cool. All right. So we'll do 2-1 monthly open And yeah, our monthly market closed technically. Whatever. All right, cool. We'll definitely be going over the Weebos picks in a minute. Just want to kind of set these guys up for success. All the new BA Pig users out there, hopefully. And all right, so we've got that going right there. And all right, yeah. So volatility is telling you about the percentage change on the candles, telling you about how in relation to the history of this asset or your sample size, how much fluctuation there's going on in the market that you're analyzing, and being able to view that in periods of low volatility and high volatility is definitely crucial for being able to get set up here. So looking at the historical volatility estimator, we can reset our settings here, and we can go in and check this, kind of make sure that, okay, so our length is looking back on the past 30 candles and in relation to the past 365, and that's just kind of a good daily way to view whether volatility is low or volatility is high with that percentage change. And that can be expressed, some people call it standard deviation, but this indicator will tell you when volatility is low, and also as when volatility is high as well. So this is a great indicator. You can keep it stock, and just that will be able to tell you when it might be a good time to kind of put some protection on. But this is just for preliminary looks here. So this is a free indicator, and checking out some more free indicators. We can go over here. So this is the new function or indicator. So you can pull that up, and you probably won't have a lot of favorites here, but we can also go towards the Hurst exponent, and you would want to pull up the D-trend fluctuation analysis, and this will tell you the market state, so the presence of autocorrelation, and just kind of looking at things, whether they're going to be volatile or mean reverting, which would be less volatile, and kind of having returns coming back, kind of going from large returns to small returns and things along those lines. So yeah, so the Hurst exponent, that's a market state indicator telling you where how the market is behaving from a statistical standpoint of seeing things in terms of autocorrelation or negative autocorrelation, and having that up on your chart will definitely help out along with the historical volatility estimator. Let me make sure. Yeah, we don't have anybody, and my audio is still running. All right, cool. So you've got your volatility indicator, and the volatility indicator is telling you when there's going to be large percent changes, and when there's going to telling you when there's large percent changes happening in the market, and when there's low returns or volatility in the returns, really. So this indicator really, so when you see it in blue, that's when volatility is contracting. It's in a low state of volatility, so you're not going to see huge swings in the asset that you're analyzing. And then when you see the indicator turn red or orange, that's when the volatility is high, and you can look into a lot of different things about volatility. Tasty Trade has a lot of great resources about volatility, but realistically, volatility will contract more than it expands, and that volatility has a propensity or a tendency to cluster. So you'll see periods where there's a lot of low volatility, and then you'll see brief periods or extended periods of higher volatility. And then you can change around some settings as well. But the EWMA works great. And if you're trading things with gaps up and gaps down, then the Yang Zhang might be better. And then one thing I like turning on is the background signal. So turn on the background signal, and that will tell you when there's an outlier occurring in relation to the past 365 candles. So the past 365 days of active trading on SPY, then right here was a period of low volatility clustering and subsequent expansion. So when you see volatility being low, then your brain should probably be saying that at some point we're going to see an expansion, and that expansion is going to be in association with larger returns, larger swings in price. So looking at things like that. So these are free indicators that are giving us like kind of market state, just saying, okay, is volatility going to be high? Are we going to see large swings in price or large changes in price, as I should say, or are we going to see smaller changes in price? And there's a lot more to these indicators, but I'm just going to try to briefly put down the free indicators. So we can increase our sample size if we want. So maybe keep it in line with our historical volatility estimator, and then as we do that, we can also change our base scale. So the larger the sample size, then you can increase your base scale, and the smaller the sample size, then you can decrease your base scale as well, just for what you're trying to look at. 4.2 is the most stable value, so that's probably going to be your most accurate read on market state by using the base scale and the max scale. Okay, so we've got our market state right here with our historical volatility estimator, and then we see that the Hurst exponent is reading significant mean, or actually just mean reversion. So if you go into the indicator, you can read about what mean reversion and negative autocorrelation really mean. It's really saying that a lower market volatility, and you're going to see returns that are kind of opposite or opposing to one another as far as their size. Okay, so we've got the Hurst, we've got the historical volatility estimator. Let's see what other free indies that BAPIG gives us. So we've also got the DWT. I preferably like to use the VRT. So let's get the variance ratio test up, and the variance ratio test will determine whether price or returns are in a state of a random walk. So a big foundation that the BAPIG methodology is built on is that price is random, and prices move in a geometric Brownian motion. So that prices are random, and this kind of supports that mathematically. It does support this mathematically, and it also tells you when there's that the market is in a state of trend. So when the indicator's blue, the market is trending, and then when you see the indicator as red, the market is mean reverting. So during the periods of blue on the VRT, you're going to see higher volatility, and periods of red, you're going to see lower volatility, or you're going to see that adjacent volatility where you see large returns followed by smaller returns and things along those lines. This stream is definitely being recorded, Spence, so I'll definitely get that out there. But anyway, so all right, so we've got the VRT, we've got the Hurst exponent. So these are all returns-based indicators telling us whether volatility is high, and also going to tell you if things are acting randomly, or if we are outside of a random walk. So right here, the market is inefficient. So when the market is outside of a random walk, the market can be viewed as inefficient. And when the market is within side of these two yellow lines, and there's not a lot of spread in between the multiple tests that are going on, then you can view the market as efficient when it's in between these two yellow lines. So these are all free indies, and they'll be kind of just indicating, and you can just go in and hit the indicators tab right here, and then you can look at the read more on a lot of these indicators. But these are the indicators that I would definitely use. And then if you see something like, okay, well, I don't agree with the fact that the Hurst exponent is in a state of mean reversion. It seems as if that would be contrary to the market state that we're seeing with these outsized returns. Then maybe you can try to calibrate some things or reset the settings, and the stock settings right here. Let me just get this onto a line. So you can change the plot style to a line, and then you can see right here that yeah, we were in a trend on the daily on SPY going up to like 14th of January. So as you get to know these indicators better, you'll be able to interpret them and calibrate them to your style of trading. So maybe what we can do is even incorporate some more data into here. So sample size, we can do 365 if we want, but I would keep them as stock and just roll with them like that, and just really learn what this all means. So as always, you can go into the defaults and reset your settings, and then I like to put that online. So all right, so when I see that's blue, when I see it's above that 0.5 line, and especially when it's green, that we're going to see volatility high. We're going to see some autocorrelation going on in between returns. That so saying, okay, if you have some large returns, they're going to be followed by large returns, and all a return is this it's that price movement and that percentage change. That's what I'm talking about when I'm saying returns. So this candle right here had a negative $85 return, or 1.89% negative. So all right, so we've got some indicators right here to tell us about market state, and we can continue. And one of the all-time great indicators right here is the historical volatility percentile. So this is very similar to the historical volatility estimator, but this is more of a frequency metric. So as opposed to being able to calculate the historical volatility, so you can see at some points here it's been ridiculously high. It's unbounded, so it can go to infinity, the historical volatility, but the historical volatility percentile can only stay from 0 to 100. So I like to move this down. A lot of traders like to move this down to 10-100, and that will give you a little bit of a quicker signal on your volatility. So being able to read that in context, and I like to change the moving average to 500. So that would just give me an average, and obviously it should be at roughly about 50. So I use these together, and you'll see some flashes and subsequent expansions, and the expansions happen quicker with the HVP than the HVE. So the HVE, you'll see a lot more volatility clustering. So like right here, yeah, you did see some expansion right here, some significant expansion as well, but it's just kind of this indicator is a little bit more of a longer term indicator, and then this is more for a short term type of analysis. So these are all market state indicators, and then we can also pull up a great free indicator is the moments indicator. So we can throw that into the search bar, and you'll see that it's the only one available, and then we can reset our settings. And this is a little bit more of a directional indicator. So as opposed to the indicators that are telling you about volatility and about autocorrelation and about whether or not the market is in a random walk, you have the mean. So when the mean is negative, you can kind of assume some negative returns if that's what you're going after. But remember that price is random, so just because the mean is negative doesn't mean that you're going to see only negative returns. You also see positive returns as well. And I like to put this onto a higher kind of look back. So sometimes, so like let's say, okay, I'll put this in relation with that HVP. So we can put 100. So our length, our sample length is 100, or our annual vol comparison is at 100. So we'll put that at 100 if we want, or we could even put this down to 10, and you can see, okay, so we have a negative mean here, and you can see, okay, well, volatility is low, but I prefer having a higher sample length, even going upwards of 500, and that puts things into perspective. Long-term perspective has so the mean's gone negative in March, and then you can see that, okay, this is taking into account 500 daily candles. So that's a little bit more indicative of long-term for the S&P 500. So that's a great indicator. But realistically, if you're only using the free indicators, then probably the best would be to show returns. So then you would show your returns, and then this will have your mean in there. The mean doesn't change. So 0.061, that's the mean. And then you can turn on the returns, and this will show you where the returns are. And then you can also put on a band as well. That will tell you where 90% of 90% confidence interval, essentially. So anytime you see returns outside of that band, you can kind of assume that we're at some form of a statistical outlier. Let's see here. Anything else that may be noted here? Just double checking here. I mean, so yeah. So just looking over here on this most recent dump, and with the BA Pig methodology, it's really rooted in statistics, and being able to use that terminology is something good. It's something that should be when you're talking with people that are really deep rooted in statistics. They're not going to use terms like dump and pump and stuff like that. Other than that, like, you'll see a lot of people on Twitter and stuff like that using that terminology or whatever. But realistically, these are negative returns, and then obviously the subsequent positive returns as well. All right, so these are all free indicators here, and yeah. So let's see how we can kind of put these indicators in. Am I missing any indicators here that are free? If there's a free indicator that you're saying, hey, why aren't you using? Please feel free to shout it out. But a lot of these indicators are omega ratio. I would definitely use the omega ratio in there, but I would kind of put that down until you really need to use it. But the big ones are historical volatility percentile, historical volatility estimator, Hurst exponent, VRT, moments, and just by putting the moments, showing the returns, that's big, and showing the bands as well. That's good for finding statistical extremes. And look back is set to 30, so maybe we should keep it at 30. just to be able to see how you can kind of see, okay, well, mean's negative here. We're seeing some outsized returns right here, but maybe even putting it to 10 might give you a quicker signal. I'm seeing how the mean goes negative right here, and then in relation, maybe we can make this a little bit more. So then that would be, I think roughly, I think maybe only 0.3% of the returns should be outside. So the returns, these are the raw returns, the red dots, and then the mean is the white line. All right, so the way that I read this right here is that volatility is high when you see that HV percentile. So 86% of daily returns had lower volatility than the current candle, and being able to interpret that, and you can kind of put whatever settings you're looking for. So if I drop this down to 5, for instance, you can see how the clustering isn't as apparent, and the volatility extreme is still there. But yeah, putting that right there, I mean, and the HV percentile is still in the 90th percentile. So being able to interpret this is, okay, so volatility is high. I don't think that we're going to see much more expansion, and you can see how trend is going back into just regular trend as opposed to significant trend. And when you see that the Hurst outside of the bands, again, that's telling you that the market is inefficient. So and similar to the VRT as well, that right there is signaling that the market is inefficient, and that, well, depending on the market that you're trading, how quickly that efficiency comes back into the market, or the efficiency or the state becomes more efficient, is definitely, it's not going to happen every single time that you see positive returns right after that, but that's just telling you that, okay, so when you see the Hurst exponent and the VRT outside of those yellow lines, that white dotted line, that we're dealing with an inefficient market. Okay, so yeah, so we can zoom this out to a weekly if we wanted to, and we can see how we're in a significant mean reversion here, and that the VRT is supporting that as well. 85% of weeks were lower than this in comparison to the past 365 weeks. So I think that would be a little bit too high. So maybe we can compare it to past 100, and we can, okay, so 70%. But thinking about that, the past 100 weeks, I mean, that's beginning of the coronavirus scare and things like that. So maybe it would be wise to increase this to a much further out scale, and saying, okay, in the past, in the lengthy history of S&P, that the volatility is high, but the HVP, which is bounded at 100, is saying that there is actually some more room to, I mean, volatility can be infinite. So I mean, looking at that right there, there could be some more expansion coming, but seeing above that long-term moving average over the past 500 weeks, that being above there is pretty much expanded, but it can definitely expand some more. And then looking at the returns right here, so then we can actually, now that we're on this, we can actually get this back to stock settings, 1.96, and that's a confidence interval z-score. So looking at returns here, that was a major outlier right here on the 18th of January, and yeah, it's not always going to work out like that, and obviously hindsight is 20/20. and you'll see that a lot with people that are trading moving averages and things like that, being like, oh, the 20 SMA or 20 EMA called it, but in real time, it's you're not going to be able to read it with the EMA or an SMA. So I have properly indicatored up my trading view here, and yeah, these are all free indicators. And yeah, just if you're coming here new, those are some of the ones to master before you get acquainted with some of the more advanced concepts. But yeah, these are the free indicators, and going into the paid indicators, and this is where the magic happens, taking these fundamental concepts and then putting them into more specific kind of areas. That's a big kind of shift that you're making with your trading. So just know that yeah, it takes some time to be able to learn a lot of these concepts, but it's definitely manageable. Anyway, so let's see here. Yep. We could maybe do some correlation. But all right. So going back. Oh yeah. So let's just analyze some markets with these free indies, and then we'll go on to the paid indies and see if those are giving us any more insight than the free ones. So significant mean reversion. So what does a significant mean reversion really indicate? A significant mean reversion indicates that the market state. But this is on a weekly right here. Looking back at the past 100 weeks, maybe we should zoom this out a bit. And zooming out, we can see that this is actually a trend. So the sample size is big. So what are you comparing it to? Are you comparing it to the most volatile, one of the most volatile instances or examples of all time? Like if you only have 100 sample length look back, then you're only looking at things with a basically with a microscope. You're looking at, okay, this is in comparison to the past 100 weeks. When you're looking at things with a 1,000 look back or 1,000 sample size, well, you're looking at things in terms of decades, right? Or a decade, and that's something that you need to take into account is being able to put into your kind of lens. What are you trying to look at? And usually the higher the sample size, the better, the more data that you're bringing in, and the less you're trying to model price, which is random, and more you're looking at historical returns. So I increased the sample size, so maybe we can go 16 on that base scale, and that's saying mean reversion. I mean, you can turn these labels off too. And then looking at 4.2, and that's saying that the market's in a state of trend. So trend being higher volatility, being that there's more autocorrelation present in the market. That you're going to see some larger returns. You're going to see higher volatility, and looking at that, I think that the stock right there, 8.2, is cool. I mean, we can even do 500 if we want on the sample, and being able to interpret things like that. And okay, well, we can. But realistically, the stock settings will get you where you need to be if you're able to kind of pick those up on terms of what trend and what mean reversion is. That will help. And seeing that we're below this 0.338 confidence interval. If you turn on the indicator name label, you can see the confidence interval coming in at 0.338, saying, okay, we're outside of a random walk, or not outside of a random walk, but more so that the market is inefficient. Okay, so all right, yeah, looking at weekly S&P, maybe not the best thing if you're trying to look at kind of, well, it just takes some serious time. It takes some serious patience, and depending on your trading strategy, well, that took 146 days right there to go into that inefficient market state. And just because it's in significant mean reversion doesn't mean that you're only going to have small returns. Significant mean reversion is flipping of returns. It's going from large return to small return to large return, and viewing things along those lines. But yeah, this is the free setup, and and then the moments. It has a panel, and that will tell you, okay, is the mean negative or positive? Variance, is that high or is that low? Skewness, are we expecting frequent negative returns, or are we expecting significant positive returns? So looking into skewness is definitely something to research, and then kurtosis as well. So the tailedness of the distribution. So how many large, like really large returns do we have that are outside of that first standard deviation, more towards the second standard deviation? So I'm throwing around a lot of these terms, and it might seem like word soup. It kind of is, with just me personally describing it, but there's a lot of terms that go into it, but the core concepts are probability, volatility, and market state. Those are some of the core foundations of what BA Pig is all about. And okay, yeah. So this is the free section right here. And all right, so we'll go to a more manageable time frame. I like the 2-day, and so then we can realign things. So whenever you're switching time frames, well, yeah, I know it's kind of a pain to have to change your sample sizes and stuff like that. But once you find time frames that you like, then you can quickly do it, quickly make changes. But all right, so we can keep that on. I mean, for the past 10, I would maybe look at past 50, and I like to standardize things. So if you're looking at a week. There's 7 days worth of trading. So then if you're dropping things down to a daily, then you might have to increase things of that magnitude from that change to just keep things consistent. I don't change the VRT, and as the Hurst exponent, if I'm going down to a 2-day, let's say, then I'll probably increase that, and then see how things look. And see if there's anything significant that time frame is indicating. But we'll just keep it stock, base scale, max scale, 8.2, and looking at volatility here. You got an HVP flash right here on the 16th of November, and then you saw historical volatility percentile expanding. And we see VRT as well. The mean is back positive. We got negative for a little bit of time. And then looking right here, we saw a rather large outsized return. Let's see. If I put that onto 500, maybe we can drop this down, or let's keep this at. Let's actually put this up to 1,000, and then we can put this up as well. Let's see what that looks like on 1,000. Really like the law of large numbers, and putting that into perspective as well. That you do need a large amount of sample size to be able to have some statistical real measurements made. Because if you're only looking at 10, well, I mean, 10 2-day candles in the history of SPY is a drop in the bucket. So looking at that, yeah, I mean the 2-day mean on SPY has been positive for I mean, forever, really forever. Over here in 2008, you saw the mean go negative. So that would be something significant if we saw the mean go negative. And then you can see the skewness is insignificant and kurtosis is significant. So what that's telling me is that this distribution has more extreme occurrences than is modeled by the normal distribution. So the normal distribution saying, okay, 95% of occurrences happen here, but for the S&P 500, there's more occurrences in the 5% or the tails of the distribution. So a lot of this is probability theory and statistics, and putting those in. Using all these returns and putting them into a distribution, and viewing them like that, and particularly a log normal distribution. That's the way that stock prices are best modeled, as far as I know, and that there are and then looking at returns, you can look at those more normally distributed. But yeah, log normal distribution is the way that stock prices are modeled. So anyway, so looking at so Hurst exponent here, maybe I'm well, I increased that. So let's see what the 16.2. But just looking at VRT, kind of going into a state of trend. There's not a lot of spread in between the different tests. So there's 4 different VRT tests going on. So you have one VRT that's positive 1.13, and you have a VRT that's negative 0.572. So that is a decent amount of spread. So kind of indicating that we're not as much in a random walk, but that's something that we can just go into the indicator, and we can look at the variance ratio test here, and we can look into that and say, okay, this is about price following a random walk, and it's a test for market efficiency, autocorrelation, and whether price follows a random walk. And so then you can go down to the part for people that are too lazy to read math, and then just looking at that, saying, okay, red means possible negative autocorrelation, mean reversion, blue means possible positive autocorrelation, trend, and then above or below critical levels means price does not follow a random walk. Between critical levels means price follows a random walk. So they're your critical levels, and other than that, so don't really put too much. Just kind of read it that like the way that it's put in the description about how being above the yellow lines, meaning that the VRT or that price is not following a random walk, and that when the indicator's blue, you're going to see higher volatility, and when the indicator is red, you are going to see low volatility followed by high volatility, and high volatility followed by low volatility. It's not a strict order by the variance ratio test. It's just showing you what the market state is according to these tests. Okay, so yeah, volatility's high on the S&P 500. The mean is still positive on a 2-day here, and the kurtosis is significant. So watch out for those fat tails. Okay, so let's check out the NAS. And what I'll do is, because I've done a fair amount of, well, I didn't really do too much with this, but I'll reset the settings real quick. And yeah, we'll just go with stock settings, because the people that made the indicator are plenty intelligent, and they kind of make it easy for newcomers. So looking at the Nasdaq, we're seeing high volatility for the past what is this? For the past 1,000 2-day candles. The volatility has been lower 96% of the time. So definitely high volatility. We can even put this on 30 if we want, and still the volatility is significantly low, or significantly reduced. Or no, it's not. It's in the 90th percentile. So 90% of candles were lower than this. And then looking at the VRT going into a state of trend, so we can kind of expect for some larger returns here. And looking at this return right here, that was outside of the confidence interval right there. So that's definitely something to know. All right, let's go over to, so you'll see like the NASDAQ, the Dow, but mostly like the NASDAQ and the S&P 500. Those two markets are comprised of a lot of the same components. So you're not going to see too much difference between those markets most of the time, I'd say. So we can look at what everybody came here for. BTC. Let's see what BTC is showing us. All right, so we're seeing that the market is in a state of mean reversion, and by looking at that mean reversion here, and what we can kind of infer from that, well, the mean's positive. So looking at this mean reversion, we're not going to see large return followed by large return. High volatility followed by high volatility, and then looking at the historical volatility percentile being in the 40th percentile, which is much different than the NASDAQ, which is in the 90th percentile. So looking at that 40th percentile, well, that's telling me that Bitcoin can definitely get more volatile from here, and yeah, so that's kind of the analysis on Bitcoin. If we wanted to, well, that's why I have the HVP set here on a lower sample than the historical volatility estimator over here. So this is going to take our long-term volatility into account. The only thing I don't like about this is that I'm not seeing a lot of flashes. I don't see any actually. So let's drop this. Or actually, what you want to do is you want to turn that down, the percentile length and the annual, and then you can see, okay, there is a large volatility flash right here on the 2-day, and that corresponds with a lot of positive returns. So, and then you can see over here, okay, volatility is high, but remember that volatility has a tendency to cluster. So just because it's high doesn't mean that it's going to contract all the way tomorrow. And you can see over here as well, that was, so this is something significant. When you see the historical volatility estimator flashing, then there's going to be some expansion, but it could, depending on the time frame that you're on, I mean, it could take 80 days. It could take so it can take some longer periods of time. Let's go back to the chat and let's see what's going on in the chat. Onyx, my dude. Hey, thanks a lot, Trader Jeremy, my man. We're definitely trying to get some more of these going on, and hopefully get my head out of my ass in one way or another. So looking at the mean reversion here, and okay, so while the 2-day isn't showing us much, maybe we can go to a daily, and okay, this is where so people always ask what's the best time frame to trade on, this, that, and the other thing, but it really is just being able to look where the extremes occurring and what seems likely. You got to be able to bring into account multiple different time frames, and then be able to have that perspective that when I switch this to a weekly, well, that's now multiplying what I was looking at times 7. So each of these candles have 7 days worth of returns and baked into them, as opposed to this daily, which is only 24 hours worth of returns data. So while the 2-day volatility is decently expanded, but on the daily, the volatility is still rather low. But looking at the historical volatility percentile, you can see that there's multiple flashes going on. You can see over here, and also over here as well. You saw that expansion. Let me see here. So yeah, putting that on 1,000, it doesn't really help too much. I mean, you're just going to see a positive mean. You'll see like the confidence intervals might be a little bit better for catching some outliers, but looking at the mean, it's not really helping us as much. So maybe I should put that down to what we're looking at over here on the HVE. I would like triggers for entering trades for me. It's definitely a combination of things, but definitely the HVP. Knowing that when you see that flash, you're not going to see like 100 candles after that of flash of volatility being low. You'll just see, and you can see it, but I don't see it too often, or I've never seen it, to be honest. So looking at the VRT here, you can see that we're going into a state of trend here. Besides VRT4, we're actually even getting close to that critical value. So saying that, okay, the market is actually outside of a random walk, and what we can do is we can actually put that at 10%. So 1% would be 2.58. Okay. So if you want to have a real strict critical value, then you can put it at 1%. So that'll be like, okay, only 1% of value should be here. So this is really something significant. And then if you want to have more laxed, okay, so 10% of value, or 90% of value should be in between these two lines. That okay, we are actually getting outside of a random walk, and you can that's kind of just a trigger for a little bit of a quicker signal maybe. So then maybe what we can do also here is we can turn that to a histogram if we want, or we can change that to columns. I think columns might be best for seeing those negative. Okay, so then you can see over here, HVP is flashing, and then you have a negative mean right about here. So you can maybe make a bet that you're going to see a volatility expansion on the same side as the mean. So that being a negative, so you could bet on a negative return. That's not a bad strategy. And then over here you can see that we have a positive mean, and that volatility is low. So maybe over here you could get some positive deltas on, or bet that Bitcoin's price is going to go up, or that returns are going to be positive and they're going to be large. Wouldn't be the worst thing to bet, because the past. So then we can take this into perspective as well, and we can look at the Hurst exponent, and this is in relation to the past 100 candles. Where was I going with that? Oh no, it's actually the historical volatility estimator. So this is in relation to the past 500 candles. So past 500 days on Bitcoin. And that the historical volatility percentile being in the 11th percentile is 11% of days were lower in the past 500 for that sample. So that's definitely something right there. And so these are all free indies, and these are great ways to be able to view returns, and you can do it for longer term analysis. So if you look at the monthly here, and this is on 10, right? Yep, that's on 10. So then we can look at this and we can say, okay, well, returns. So the monthly mean is negative. So that's something to note, and just being able to take into account those times where Bitcoin's mean is negative on the monthly, and then we can look over at things on the weekly. And we can say, okay, well, the mean's been negative, and this isn't like supposed to be a total way to trade. This is just okay. You can make some you can test your hypothesis, and just remember that it is that the market price changes are random, but we can use statistics to our advantage to be able to help filter out some of that randomness. So maybe we can check out Ethereum. And we can see over here that the volatility expanded over here when Ethereum was at $4,000 in ETH, and now volatility is still, and that's why having both of these indicators up is nice, is being able to take that into context with the past 500 candles and saying, okay, well, actually, that meme actually, but the historical volatility percentile, 30% of daily candles were lower. So that's something to definitely take into account. And yeah, so Bitcoin, that's definitely the asset that I'm looking at, and seeing that on the daily here. So let's put this into account on the same sample size as our historical volatility estimator, and putting that sample size at 500. Excuse me. And so we can put that at 500. So now we're starting to see some things here that seem to me to be a little bit more indicative of the market state. So yeah, you can't just blindly read these indicators and think that, okay, I'm just going to 100% put my full, well, I 100% put my full faith in the indicators, but sometimes your settings are improper, or and just being able to put those into perspective and say, okay, that Bitcoin does seem more of a trending asset than a mean reverting asset, and being able to see, okay, well, that 10% return right there, that it seems like volatility is high, just from looking at things nakedly, just looking at just raw returns being just the percentage changes. Again, let me double check here. And all right, yeah, so these are all free indies, and all right, so looking at things on the daily, so the way that I like to look at things is I like to first take into account where we are in terms of just the larger time frames, and looking at the weekly here. So maybe 500, there's not enough data, so maybe we can make this 300. And then, okay, significant trend, so you're going to see large returns followed by large returns. Negative mean since the 13th of December. Volatility in the 29th percentile. I wonder how historical volatility can come up with a value. Oh, so it just took a little bit right there. Yeah, so I have these two sample lengths symmetrical, or these two are equal to each other. So then you have the historical volatility that's in reference to the past 500 weeks, and the Hurst exponent is in relation to the past 500 weeks as well. So seeing that significant trend, that seems like the market state that we've been in for some time. And then looking at the VRT as well, you can see that the VRT is outside of a random walk, so we can probably expect for market efficiency to pick up. And then we can also look at our returns here, and this is on looking back on the past 10 candles, 10 weekly candles, so past 10 weeks. Maybe we can increase that. Let's try 500. Okay, so you can see that significant SD band right there. So 1.96. The confidence interval over on the VRT is at 1.65. So maybe we should lower that a bit, and probably see a return outside of the band there, or right at the band. But maybe 500 isn't the best. We can maybe put that on 100. And you can see how So this would be your 90%. So these two lines, I know they're not that sexy or whatever, but these two lines are telling you that 90% of returns should fall somewhere in between these two lines. And when it's really outside of that, then that's an extreme. Doesn't mean that the extreme can't continue, like right here and right here. So if you bet that Bitcoin's returns were going to go positive there, well, guess what? There was another 25%. But you could also look at historical volatility and things along those lines to see if there was room for expansion, and clearly there was room for expansion there. So looking at things on the weekly here for Bitcoin, maybe we can put this down to the past year, maybe, and just kind of look at that. Not all indicators have to have the same sample sizes, but yeah, looking at the moments there, we can see how the returns are within the confidence interval. That the volatility is kind of at its HVP is in the middle, or volatility is fairly consistent, and volatility, looking at that 60 read out of 100, so about a 60% read on that HVP, saying that volatility is slightly elevated. And then looking at the historical volatility percentile, or the historical volatility estimator, seeing that 30%, so 30% of weekly candles were lower than this. So there's definitely some room for expansion in Bitcoin. And then looking at things, let's say onto a 5-day, we can see that volatility flash going on right here. Let's look at 5-day. Let's put everything in terms of this annual vol here. So let's put that on 100 here. And let's see what that reads. So we've got a positive mean, and we've got returns here right inside their confidence interval. So what this flash right here is telling me is that volatility is likely to expand. Or no, it's really not telling you that. It's telling you that volatility is low. So let's take that for what it is. So last time over here in July of 20, over here in February 19, over here in October of 18. So volatility being low, and volatility having a kind of some mean reverting properties. So saying that volatility might go back up to its mean at 49. And if that means that we're going to see some larger size returns. And then looking at the VRT, we're outside of a random walk. Market inefficiency is high. And then looking at the Hurst, state of trend. So yeah, those are all metrics saying, okay, there's some opportunity here where the market is inefficient and volatility is low, and we are seeing trend. So yeah, so there's and then the VRT does that even for you too, without having the Hurst exponent on. You're seeing that blue right there. Well, you're going to see trend. So the trend kind of started, well, seeing all these VRT move right together. Trend kind of started picking up right there. So what that trend can kind of indicate to us is that large returns are going to be followed by large returns. Okay, of course I got my phone ringing as well, but that's all good. And yeah, so all these are free indicators, and they are plenty sufficient to be able to help sort out the randomness, which is price. So now we can go down to a 3-day. So the analogy that best worked for me with all the different time frames and being like, oh, I'm only going to analyze the weekly, I'm only going to analyze the daily, I'm only going to make trades based off of a 2-day or whatever, and it comes from Balipour. Balipour is the main person behind BA Pig. He's the creator of it all. And and if you look at his scripts page, you'll quickly understand why, with the amount of just incredible indicators that he's provided to the TradingView community. So Bali-Poor, he was saying one day is that you got to look at the multitude of time frames as the way that a microscope works, or the way that a scientist looks into a microscope. And if he wants to see like kind of everything that's going on with the organism or whatever, in our case, if we want to see everything that's going on, then we can zoom out. And by zooming out, we're increasing the amount of time into each candle or each return. And if we want to see what's going on a much smaller basis, if we want to see what's going on kind of on a right now basis, or if that scientist wants to see what's happening just in a small specific area of that organism, then he'll zoom in, and by zooming in on the time frames, then you can get a much more myopic type of view, a much more just granular type of view that you're seeing on a daily return. While you might not see that with a weekly, because it takes 7 days and a close to be able to update this indicator, while as opposed to this takes 24 hours. So there's a huge shift going from a weekly to a daily, and same aspect going from a monthly to a weekly, or from a daily to a 4 hour. So using that analogy, if you're like, wow, there's not a lot happening in Bitcoin volatility right now, then all right, go down to a 12 hour and see what's happening on the volatility, and see if you're going to see that expansion occur. Right. So on the daily, we didn't see a volatility flash or anything like that. But on a 12 hour, we saw the volatility flash right here saying, wake the fuck up. Excuse my language, but that you're going to see a volatility expansion, and the VRT as well, looking at that VRT and saying, wow, okay, we're in a state of trend, and ultimately we're in a period of market inefficiency. So putting those together and saying, okay, well, the daily might have not seen that, but you saw it definitely on the 12 hour, and so being able to zoom in, being able to use these time frames to your advantage is huge. And looking at things like, well, this is just technically this is a 12 hour is just a little bit more of a zoomed in version of the daily, and the weekly is a zoomed out version of the daily, incorporating 7 daily candles into that time frame. So yeah, and then looking at the 12 hour here. Well, let's get this back to columns. I like that on columns. And then we can kind of pick this up here, and we're still seeing a negative mean right here. We're still seeing significant kurtosis. So when you see that significant kurtosis, well, that's indicating that there's a higher probability of seeing outsized moves, or that there, not that there's a higher probability, but more so that there's a higher tendency for outsized moves. So looking at this on BTC here, that HV percentile is in the 48th percentile, so on the 12 hour, and we're not outside of a random walk. So going from the daily, while there is extreme volatility occurring on the 12 hour, on the daily it was actually turning into kind of contraction. So the way that I read all these free indicators that BA Pig ever so graciously lets us use is that we're negatively skewed. So negative skew, kind of saying that you're going to see frequent positive returns, and then you're going to frequent insignificant positive returns, and then you'll see rare cases of significant negative returns. So that's what skewness is. Skewness is telling you where do the majority of returns occur, in a brief way to put skewness, and putting those into perspective here, and then seeing that negative mean, and then seeing how the VRT is going into a state of market inefficiency, and looking at the Hurst exponent in a state of trend. This is in relation to the past 500, right? Let me see. Yep, past 500, and yeah, looking at that, and as well as the volatility being low. So there's going to be some increased volatility at some point here. But is it going to happen on this next 12-hour candle? Probably not. Just looking at the HV percentile, and then also, yeah, well, HV percentile being this indicator right here, and then you can also look at it in relation to the historical volatility estimator. So let's drop things down to a 6-hour, and you can see significant mean reversion. So that's going to say that, okay, well, there'll be large returns followed by small returns, and small returns followed by large returns. And then you can see how the Hurst exponent is kind of going into states of mean reversion and states of trend. So really the market state is tough to determine just by looking at those indicators. But I would say that it's mean reverting. So looking at that 6-hour here, yeah. So volatility is not that low. It's in the 50th percentile. Let's check out. Yeah, I mean the 6-hour. We're seeing some pretty small returns. Mean still negative. When did this mean go negative? That would be interesting. Yeah, so 15th of November, right here, you started seeing the mean go negative. Let's see. Yeah, so that was, and then looking at different expansion points right here. So right here, a point of expansion with a negative mean, and then being able to kind of put things into perspective. So if you were betting on that expansion to occur and it to be a negative return, then this might be a good place to manage your exposure, because 90% of returns, or 90% of these dots, should be within these lines right here. So you're basically betting on that fringe outlier type of occurrence. Doesn't mean that it can't happen. So then looking at that, it's saying, okay, well that negative 7% return, or negative $4,000 on that short position, or those negative deltas might be a time to reel those back in. Okay, yeah, and so yeah, if you're just joining all of this craziness and being like, there's no fucking way I'm gonna be able to put all this into my vernacular and all that, well, it just takes repetition. And being able to put the time in and just really be able to, yeah, just ask around, and there's plenty of people that are willing to help out in the incubator, and yeah, that's really what we're trying to do here. So this was just a good way when I see a lot of new people coming in, that these are all free indicators. It's not like it's mandatory to purchase the packages and all that. These indicators will help sort out the randomness that is price pretty well. But definitely once you start asking more questions, well, there's more indicators to help answer those questions. So now we can go to BTC over here if we want. Weebos, I'm really sorry, my dude. I really wanted to check out your list today. We can definitely check out your list too. But I went a little bit over time with the free indie explanations. So yeah, so this is Bitcoin. So going off of that, so basically being able to go over this real quickly is, all right, so I have 3 different historical volatility percentiles here. Do I need 3? No, but it's just kind of good to be able to spot possible expansion areas. And so the rationale behind that is having a large sample length right here, then having a medium term sample length, or a small term sample length right here actually. So you'll see on this indicator, let me just make that full screen. You'll see expansion. So you'll see, look how many flashes there are, right? So all those flashes saying, okay, well, volatility is low in relation to the past 4 candles, and then this is a medium term, medium sample length, and you can see, okay, volatility expansions are a little bit rarer to find, and then this is stock settings right here. Besides the fact that I made it an area chart and changed some colors, but this is stock settings right here. So then you can see, okay, over here, it flashes only a couple of times. You see some extreme clustering right there, but then over on the small sample length, you see clustering that or volatility expansions happening all the time. Let's see here. Maybe make that red. Cool. And you can see all of the expansions that occur. So this one might be a little bit more significant when it flashes, and this will just kind of help time entries and things along those lines. And then underneath here is historical volatility z-score right here. So that gives you the z-score of volatility. And then this is like a kind of this is entropy. Entropy also tells you the amount of randomness going on in the market. It will tell you the efficiency of the market. So when entropy is at 1, it's very difficult to be able to predict outcomes in your independent variable. Very difficult to be able to predict outcomes, which our independent variable is price or returns right here. So then this is a market state indicator, very similar to the VRT that I still have present down in the bottom right corner here. But this is just telling me whether the market is efficient or inefficient. And then we have a correlation put onto it. You don't really need to do that. That's just I don't know, mean reversion. And then you have a mean right here, or this is actually a z-score. So this is a z-score of that mean. So letting you know whether things are negative or positive on that mean. And this is a volatility metric right here. So this is the QCV, and that's the quadratic coefficient of variation, something along those lines. And this is going to tell you when volatility is high, or when variance is high, and when variance is low in the asset that you're viewing. And then this is that's our historical volatility estimator, and that's in relation to the past 100. I was probably looking at that on a weekly. I'd like to put that up some more here. I'd put that up to like probably 1,000. And you can see the HV percentile is in the 4th percentile. So 4% of candles were less volatile than this. And then we have our MOM3G2. So this is so thinking about the mean on that moments indicator. That's like a simplified version of some of these z-scores, and it's just a simpler calculation. And this is a MOM3G. So this will kind of tell you when you can expect things, or this is when returns are positive and when returns are negative. So you can see how returns went positive right here, but there is also a ZMA on there. And I don't want to overcomplicate things for the newer people, but basically just a way to look at things and say, okay, well. And this is bound by 1 as well. So when things are at -1, that's kind of getting into extreme territory. And when you see things at +1, it's also an extreme territory. And then I've got my mean right there. Not really doing me too much, but it's also giving me that panel as well. So letting me know when things are significant. And looking at a TQC right there. I definitely have some work to do on the charts, but and then this is a probability cone, so projecting the probabilities and then the expected move behind it. The expected move is similar to the moments indicator over here with that confidence interval. That's where the standard deviation band. So this is basically a simpler version of the expected move here. So this expected move is telling me that by the end of the week, there's a 20% chance that Bitcoin will close at 37,000, and there's a 20% chance that Bitcoin will close at 40,000 in relation to our sample size which is 150 weeks. So this is letting me know about where things are on the weekly, and then that green dotted line is telling me where the center of the distribution is. So putting those into perspective here, I still see that the volatility is looking like it wants to expand. It's not the lowest it's ever been. This is actually a real low volatility rate, or low amounts of variance right there. I have two of these QCVs up, but yeah. So this is a higher sample length and then a lower sample length as well. But looking at expansion, so right here when it flashes green, you can see that things are in an outlier state. So being able to put this all together, let's see what we can kind of draw out from this is that we're seeing multiple flashes from the large sample length all the way down to the small sample length. Let me move this up so it makes more sense. So large, medium, small, and then looking at the historical volatility z-score, looking at a negative z-score. So we're negative 1.2 roughly standard deviations away from Bitcoin's mean, or from the historical volatility's mean. So yeah, we are seeing a low volatility. Kind of going back, looking at that right there. So we can pull this up if we want. And we can look at right here. So, and I can even make this 2 panes, and then we can look at, okay, so volatility was extremely low right here, so -4 standard deviations roughly away from the historical volatility's mean, and then looking at, okay, so then we see it go up above the mean here, and we see some plus 1.76, and over here, so maybe this is pretty good kind of read right there, but hindsight is always 20/20. So let's see what we can project out, what we can see, because I was buying calls. I was buying calls over here when Bitcoin dumped. Well, I saw this flash right here, and I said, okay, I'm going to get long some Bitcoin here, and I was buying calls, and we saw a negative 10% move. So I spend a lot of time analyzing and things like that, but where your money's made is being able to analyze, or being able to position yourself correctly for the next move. So looking at some probabilities here. So and this right here, this is actually a good chart to look at right now. This is a monthly probability. Yeah, so this is going back 3 years worth of monthly data, and it's overlaid onto a daily chart. So then this helps me get into that larger, or that more zoomed out type of reference point, and say, okay, well, this right here is in relation to the past 3 years worth of data on a monthly. So these lines are for monthly candle closures. So we can even zoom that out to a monthly. Take our cone off for a minute, and take our dew off for a minute, and then these are monthly probabilities. So these are telling us kind of going back to that mean, right? So going back to that mean and saying, okay, well, these lines right here are representing the 90% confidence interval. So 90% of returns should be in between these two lines right here. And then going back out to here, this is telling us that 99% of returns should be in between these two blue lines. So that's why you can see there's such extreme projections, or such extreme expected moves, that there's a 0.15% chance that Bitcoin closes this month at 22,000, and then there's a 0.15% chance that the Bitcoin closes at 148,000. So those are extreme probabilities, and then there's a 2.5% chance that Bitcoin closes at 78,000. and then there's a 20% chance or 30% chance, right? Let me double check that. Yeah, 30% chance that Bitcoin closes at 46,000, and a 30% chance that Bitcoin closes at 35,000. And then you can look at the middle line of that expected move right there, the center line right there on the monthly at 36,000. So that's kind of your the center of the distribution, where that is. So looking at that center line right there being at that 30% probability, it's definitely something of note. And yeah, so this helps keep me in line, saying, okay, well, this is a daily. These represent 24 hours worth of price data. This or 1 day of price from, I think it's from like 8 o'clock to 8 o'clock the next day, of price changes. That these lines right here are representing monthly probabilities of Bitcoin closing. So when I see Bitcoin at this area right here for the month of January, there was a rather low probability of it staying at 33,000, and we can see the monthly closure here in relation to that expected move. It closed outside of the 30% probability, but not at the 2.5% probability. So you can see how the wicks kind of correspond, or the expected move kind of corresponds with some extremes in Bitcoin's price. So that's definitely something of note. There's nothing like just looking at those wicks. There's nothing that's specific, like they knew that there was a 2.5% probability, or whoever knew, or whatever. That's not the way to look at it. It's just saying that price was not likely to close right there. It was not likely to close right there, and it was not likely to close right there either at 66,000. So when these people make these prognostications about Bitcoin going to 100,000 by end of month or something like that, then you can say, okay, well, what's the probability of it going to 100,000 by end of month? Well, we can definitely use another indicator for that, but I mean, there's a difference between Bitcoin closing at that price, which that's what these lines are showing, and then there's a difference between Bitcoin just touching that price. But this is in relation to Bitcoin closing. So let's check back on here. No bands on HVZ. I actually like using the confidence intervals better, or the areas right here. So looking at the 2 and the 2, and then I like looking at when HVZ is above its mean. So I do have the bands checked, but I don't have the actual bands on. I know, right? So stupid, but just kind of looking at that. I like to keep that in perspective of -2 standard deviations away from the mean, and then +2 standard deviations from the mean, and then in relation to where the mean is of the HVZ. But yeah, Unk Pow Pow is the man himself, that puts in all this time, and is really the reason why I got into this level of quantitative trading. But anyway, so then when somebody says, oh yeah, like Bitcoin going to 100K by I don't know, let's put this onto a weekly, let's say by June of 2022. Well, we can turn this on, and this is the probability cone. So now this is taking our expected move, and it's in some sense or another projecting it out into the future, and being able to look at that and say, okay, well, if somebody's telling me that Bitcoin's going to be 100,000 by June of 2022, well, there's a, let's see here. Let me get this Cone Pro just set up for what we're trying to do. And then let's see, on the weekly, let's put this back a little bit more. Let's put this back to 250. And then saying, okay, there's a 30% probability that by June Bitcoin will be at 50,000. So reel in your expectations there, because the math is saying otherwise. And then you can put this up. Okay, let's see the probability. Okay, let's see a 5% probability, right? 5% probability that Bitcoin will be closing at 92,000. So the probability that it will get up there is different than the probability that it will be able to close a weekly candle at that $92,000 mark. So just putting that into perspective as well. But yeah, so being able to use a lot of these different tools, whether they're the free tools, and the free tools work outstanding. If you're using the free tools, then you're better than 90%, 95% of retail traders out there. And then once you translate that knowledge into asking more questions, that's what these indicators really do. Is when I have a question, I go into and I refer back to the math and say, okay, well, are my expectations in line with reality, which is math, and then I can either reel those in or whatever. But being able to ask questions and then be able to determine them or answer those questions with the BA Pig tools is where it's at. But yeah, let me just double check on the chat here, and thanks a lot, Unc. Are you in Discord right now? Maybe not. No. But yeah, if you want to hop on, I'm definitely kind of looking. Well, I'm just looking at Bitcoin here, and I'm thinking that we're gonna see a pump here. So let's kind of go into the way that I would be able to determine if there's going to be a pump, or if we're again, I have to get those stupid terms out of my brain. If we're going to see some positive returns, I really want to start kind of upping my vocabulary a little bit here. So looking at this expected move is on a 2-day right here. That's taking into account the past 500 2 days. So we're kind of at the upper end. So there's a 20% probability that we close this 2-day candle, which this 2-day candle is closing in about 2 hours, 2.5 hours. So we'll get a new probability for that, but there's a 30% probability we're closing there at 38,000. So maybe not the best time to put on some positive deltas. And then also we have our XEM below its due. I was trying to get some positive deltas on for over here, which is back in December. Yeah. So back right at Christmas, I was looking at some positive delta or just getting some. Or just thinking that Bitcoin's price is going to go up, and we were below the XEM or the due, and the XEM was still negative. So this XEM has been negative on the 2-day for. Yeah, it's been negative since the 13th of November. So just kind of saying that Bitcoin, you're not looking for as many positive returns here. You would probably be looking to sell that actually, when you see that negative XEM there. But yeah, that's and then in accordance with the expected moves as well. So then you can turn off the XEM and the due, and then you can look at different probabilities here. And this is on the 2-day. Yep. So then over here you can see that there was so that it closed outside of the expected move, and then you saw some more negative returns. But yeah. So this would kind of reel me back in and say, okay, if I'm looking to just look for positive moves right here, it may not be the best area to do so. Maybe wait for some more time, wait for a new expected move. But then looking over here on the monthly, sorry about that. And looking over here on the monthly, so that we just got a new monthly expected move, and we can put out the cone here if we want, and we can turn that to 500 if we want. And okay, yep. So we tapped that 30% expected move there. No, that 30% probability cone, and then looking at the daily here, and then saying, okay, well, it may not be the best time to get some positive deltas on a 2-day. Looking at things on the monthly, that there is some room to run. I mean, about 43,000, where there's a 30% chance that Bitcoin will close on a monthly at 43,000. So honestly, not the most. But I mean, a 13% move is still a 13% move. But being able to put those in line, saying, okay, well, this is a monthly, and then the 2-day, there's roughly 15 2-day candles in a monthly candle closure. So yeah, taking some time to be able to put those into perspective. But I mean, yeah, volatility is low. When was the last time that we saw that HVP flash on the 10-100 settings? It was back here on the 17th of January, and it took about 12 days on that daily right there. So Bitcoin. Okay, so then let's go to, yeah, let's check the 2-day, and let's see. Let's see what the dues are telling us. So negative do right here, negative XEM right here, negative XEM right there, and then let's check out the 2-day right here as well, and another negative XEM. So yeah, that a big and looking at the monthly that just closed. Looking at that monthly, well, we saw a 2.5% probability tap right there, and then we saw that the Bitcoin closed outside of me. We saw that Bitcoin closed outside of that 30% probability, coming in right over here. So there's a 30% probability at the beginning of January that Bitcoin would close at 52,000, and then there's a 30% probability that Bitcoin would close at 43,000, and it actually closed at 39,000. So just putting that into perspective. And then now for this new month, so people might be saying, oh, Bitcoin to 100K, but realistically, the majority of the most probable thing is Bitcoin staying between 43,000 and 36,000 for this next month here. But then there's other metrics that will be able to work in line with that as well, and saying, okay, well we see volatility flashing on the 2-day, we see volatility flashing on the daily. How about 5-day? 5-day, we're seeing volatility flashing. When was the last time that we saw a volatility flash? That was back in the 19th of July 20. So we all know what happened there. So this is the first time in over a year that Bitcoin's volatility has been flashing. Actually 2 years. So on that 5-day. So we're at a 7 read right now, and let's see here. And for the past 307-day candles, the average was about 47. So looking at that, I would expect for some volatility expansion. But I mean, look how long this one took to on the 5-day to be able to expand fully. That took 210 days. So if you're buying options, that theta is going to be real unless you're buying options that are like 3 years out or something like that. So definitely be able to appropriately position yourself is key too. Yeah, hey, thanks for coming through. Let me see here. Let me see. I'm not. I got a couple of different things going on here. making sure that I'm not. Okay. Anyway, just kind of yeah. So you're asking a question. A different language to me. I know nothing of TA. Yeah, this isn't technical analysis, but I did start out with technical analysis and realized that it really wasn't good for anything besides making memes. So then I was lucky enough to be able to come over to quantitative analysis. But yeah, when moon, I mean, looking at the 5-day here. Let's go back. Let's go over to a 5-day on some of these other indies here, and let's see. Yeah, I would say that sometime this year. I would say this year that you'll probably see some higher volatility, which could be corresponding with some moon-like behavior. I don't know what your definition of moon is. Probably different than mine, but you can use the probabilities. But yeah, I can definitely go through the probability cone. So going over to, I have my probability cone up over on that, this chart right over here. And then so let's say we can go on the 5-day and we can look at our probability cone, and right here, do you just have the regular probability cone? I can show the regular probability cone as well, but this just shows me for the past 500 candle closures here. Maybe what we'll do is we'll actually put this on to 100, and we can put the drift on for 100 as well. And bars back is just 1 bar back. What I'll do is I'll put on the normal probability cone, and that'll probably be easier. So this is the OG probability cone. There are many people trying to replicate it, but this is the OG probability cone on TradingView. And let's see, I'll take off mutual information. I'll put on the regular probability cone. The only thing, I mean, there's been some upgrades to it, but this is definitely something that you can have full faith in. That your probabilities are going to be accurate. Based on the data that you're viewing. So we can go back. So the source will keep you keep that as closed. That's just saying that all you're taking into account is the candle closure. So of the volatility period that you're sampling. So what we want to do is we want to have this be as high as possible. So we want to incorporate as many 5-day returns into this projection. So I would say going back to 2017 and then going over, so maybe 370 bars. So we'll get our volatility period being 370. And then our volatility model. You can look at different models, but EWMA would be great. Yang Zhang is great. Mean absolute deviation is great as well, and even sample SD is good too. But these are the more advanced models right over here. The Yang Zhang mean absolute deviation. So I like to keep it with. I mean, we can go EWMA too if we want. But yeah. So then our probability, we can set that to whatever we want. But 70 is a good mark. So 70%. Kind of corresponding with that first standard deviation, and then so this is 1 bar back of the probability right here. We can go 2 bars back, and that's projecting from this right here. I like to keep it at 1 right here, unless I'm in a position or something like that where I should project back, or you can also do it with in accordance with volatility too. So you can go back to the last expansion here. So that would be 14th of July. I don't think we'll be able to. Yeah, we won't be able to incorporate all of that data in there. But that's like 100 bars back. But anyway, we can take extremes too. So we can look at extremes in terms of HVP. So let's see this flash right here, 20th of July. That's going to be about 40 bars. So all right, let's see this expansion right here on the 3rd of October. Or well, we can also take a local top too if we want. But I don't really use it like that. I use it more for kind of projecting out probabilities into the future. So then with all of the data that we have, so then we can say, okay, there's a 70% probability that Bitcoin will close on the 5-day in between 62,000 and 22,000 by July of 2022. So there's plenty of opportunity. We can even go back and check the cone too. We can go back 17 bars if we want and see how that kind of corresponds, and saying, okay, well, there's less than a 70% probability. Well, there's less than there's a 30% probability, or we're outside of the 70% probability. That's the best way to say it. And then saying, okay, well, we're outside of a 70% probability here, so let's even widen out our zone here. Maybe we can even lower this a little bit here. Let's get that down to 200. And you can see how that improbable area where you see that wick right here, and the wick above that 70% area. It's just saying that it was unlikely to close at that area above 67,000, and then we can say, okay, well, let me see, I don't know, let's see 86, so a standard deviation and a half roughly. All right, so we're about that 1.5 standard deviation here. So 86%. We can even just make this 90. Who cares? We can make this 90% right here. So 90% of candles closing. So when you see that wick, that's just a touch right there. But of closing in between this cone right here. So over here, you could have some limit orders set if you're feeling brave. And then just kind of allocating based on the cone is a great strategy. And so when I say allocating based on the cone, you could say, okay, well, if price gets to the 70% area, I'll buy a I don't know, if there's specific guidelines for doing it. But saying, okay, well, if it gets to an unlikely area like 70%, like right here, I'll buy some, and then if it gets to an even more unlikely area, so let's say the 85% probability, right? Then I'll buy more, and then if it gets to an even more unlikely area, I'll buy some more on top of that, and saying, okay. Looking at those areas and saying and being able to position yourself off the probabilities is a cool way to DCA, my dude. But other than that, that should go over the probability cone a little bit, and just saying, okay, so our volatility period, your volatility model, I recommend Yang Zhang, EWMA, mean absolute deviation. They're not going to change the values all that much. Yang Zhang gives you a little bit more value, but they're not going to really change all that much. And then looking at things like your time back. So what do I want to be projecting from? We can project back from here. So this would be 3 bars back. And looking at that and saying, okay, well, going back from that candle right there, that by 25th of June, 70% of candles should close between 75,000 and 23,000. But then you can move it back to the current candle if you want, and then assuming a non-zero mean, so that would take into account drift. So that would make your mean So it wouldn't be a symmetrical probability. So then we could put this back for 200, and this will take into account drift on the asset that you're analyzing. So then you can see how going from a zero mean, so saying okay, this asset is just kind of a flat asset. It doesn't have a lot of drift to it. Or you can go back and say, okay, well, we know that Bitcoin's has had some significant returns, so let's take those into account and let's make our mean positive or negative with the non-zero mean. And then scaling with autocorrelation, you can do that as well, but I don't normally do that. But you can. It definitely helps. And then the panel and stuff like that. You can show the panel if you want, and then that will give us at what point. But I just use approximations, and yeah. So and you can show your probability as well. So just to remind you that this is a 70% probability, and yeah, you can do a lot of cool analysis with the probability cone. We can go back. I don't think we can go back that far. You can go back as far as you want, but being able to project it all the way was an update made to the cone. So it's looking at that 40% or 40 bars back, and then putting this in line. We can say, okay, now I want to know where's my 90% confidence interval, and going back and saying, okay, well, that seemed, so you can keep it at 72, and just saying, okay, well, you saw Bitcoin's returns for multiple weeks above that 70% probability, but then you can see kind of a return to a more normal probability, I guess. But you can even go back to 27th of September. So if you just hit shift and then click and drag, you can go back another 60 bars on top of that. So we can go to 101 bars, and we can see our probability. But I mean, what's the sense of knowing that this was improbable? Not that much. But yeah, that's the older version of the probability cone. And looking at things right here, that we're seeing some I mean, by April of 22, I mean, there's a 30% probability that Bitcoin closes at 62,000, and a 30% probability that Bitcoin closes at 27,000. So then you can kind of say, okay, well, looking at your 30% probability of the downside, that's 28% down, and then you have a 67% kind of increase in price. So just looking at that, and then we can also turn off the non-zero mean if we want, and it's still to the downside. And let's do April 1st. April 1st, 32% down, and then April 1st, 47% move higher. But those are the extremes. You're not really betting for that, unless there's some type of market that seems like it's underpriced or overpriced. Then you might be able to get nuanced with that. But that's for more higher level type of traders. But yeah, I think that today was a great stream to kind of look at some of the more fundamental building blocks, and then also going into some higher level stuff. Yeah, if there's anything that you guys want me to cover real quick, or cover at all, please feel free to let me know, whether it's in Discord, whether it's on Twitch. Thanks a lot for kind of sticking through the stream and all that. And BA Pig has all your trading needs. And check out Volatility, check out bapigindicator.com, and go from retail to quant. Thanks, everybody. Peace.